Indeed, I do. I have two electric cars actually in the family. So, welcome everybody, wherever you are in the world. As Geoff said, I am literally just in the process of strapping my seatbelt in because we're taking off. So, we're going to start. We are indeed zooming off. Okay, folks. So why don't we get started with this? I'll hopefully just share my screen with you guys. So just bear with me for 2 seconds while I share it. So. Sometimes when I talk about these, the world in terms of how it's working, I think one of the things we have to bear in mind is for me, the granddaddy of it all, the most important market that I can ever follow in the world to try and get an understanding of what's happening, the way things are working, is the US Treasury bond market. And in particular, I like to focus on the two big yields at the end. So the 10-year yield, which is the one that often you hear people talking about, and also the 30-year yield. Well, today we're just going to look at the 10-year yield. Now, because of a quirk of my systems, and I have absolutely no idea why that's the case, they get the decimal place in the wrong point. So at the moment, for those of you that can't see, this chart on the left here is showing 1.557 is roughly where the 10-year yield is at the moment. So 1.55%. Well, that's quite interesting. Now, you're saying, Julian, well, why is it quite interesting? Well, we'll look at the technicals in 1 minute. The second reason for me why it's quite interesting beyond the technicals is that inflation is sitting there at 5 point something percent. And so when I talk about, and some of you have heard me talk about transitory inflation, there is inflation at the moment. I'm not denying there's inflation. What I'm saying is that I believe that the inflation that we're seeing right now is caused by some supply chain shortages, and is not caused by a fundamental shift to a much more higher inflation-based environment. So why am I saying that? Well, one of my key indicators for saying this is to look at the bond market. Yes, yields have been rising. I grant you they've been rising. In recent days, they've gone from 120. Recent weeks, I mean, they've gone from 120 to 155, but they still have a one handle in front of them. So why do I think that inflation is transitory at 5%? It's because having negative real yields in the bond market is quite unusual. In fact, having negative real yields of 3% is in fact incredibly unusual. So which is going to give? Are yields going to rise towards the inflation rate, or does the bond market know something that we don't? My bet is the bond market's rarely wrong. It normally gets this right about 90% of the time. I don't think this is one of those 10%ers, guys. So my prediction here is the rate of increase of inflation, so if you like the first derivative of the inflation rate, as we know has been falling dramatically, is going to cause the inflation rate to start to underperform fairly quickly in the course of the next few months. So it's going to be a rocky ride before then, but over the course of the next 3 or 4 months, I'm expecting to see those inflation numbers really start to turn back down again. So what's going to cause that to go wrong? Well, things that are going to cause it to go wrong are significantly higher energy prices, because energy prices are inflationary, but at the same time tough for the rest of the economy, because the prices of so many goods are dependent upon the price of oil. So if the price of oil continues to rally beyond the $85 mark and heads up towards 100, that is in the very short term inflationary, in the medium term deflationary. Okay, so that's a key message here. The higher the oil price, the more it has a hit on the economy. You can already see what's going on in the White House at the moment. Biden is encouraging everybody around the world to ship more oil, right? He wants the price to be stabilized, if not to be a little bit lower than where it is now. Helps his inflation numbers, helps him get re-elected, of course. Okay, so there's our thinking at the moment around the bond market. So one of the interesting things that I'd like to just point out here, maybe I can actually, hopefully, I hope we actually have this. Can I pull up I have the German Bund. So this is a chart of the weekly chart of the German bond market. Now, this is very interesting. Why is this interesting? Because here, right, yields are around about minus 50. So crazy, isn't it? 10-year yields are negative 50 basis points. Here, they're about minus 10 to minus 12 basis points. Basis points, not interest, not percent, but basis points. It's 0.12%. Okay, so we're seeing here a major consolidation and potential trend shift. You saw the big drop in rally in prices here, which means a decline in yields. Then yields here haven't been able really to make much headway through that minus 50 basis points, and now they're coming back to break even again. Very interesting outlook. That to me looks to be turning a little bit more bearish, but for the time being, okay, for the time being, we still have negative yields in Europe, which is amazing, guys. So why does that matter? Well, let's go and look at our favorite currency pair of all time, which is the dollar index. Okay, I just want to highlight what's been going on through 2020, right? 2020 saw pretty much a bear market for the dollar. Now, why was that? Well, because the dollar was printing lots and lots of extra dollars that the Federal Reserve then used to give to the government. But in doing that, they had to buy bonds. You guys know about this QE, right? Okay, so they thought the world was awash with dollars, and then they missed out and they forgot about something really interesting, which is called the commodity price rally. So as the price of the US dollar stabilized around these levels in May. From about May was the point at which time there was a huge rally in commodities. There was some incidental specific rallies in commodities in this area here, but it really kicked into the energy complex from about April, May onwards. So why is the dollar rallying? Well, the dollar's rallying, guys, because if you paid $8 or $60 for your petrol 3 or 4 months ago, and now you're paying 85, don't you need an awful lot more dollars to do it? So the dollar is rallying because we are sucking dollars out of the system now. So think about this, right? As the price of oil goes up, this is crazy, the dollar will go up too. That isn't what's happened in the past, but that's what's happening now because the supply of dollars is too small. Isn't this crazy? Don't forget, still 80% of world trade is denominated in US dollars. That doesn't just mean the energy market. That means coal. That means natural gas. That means wheat. That means soybeans. All of those things denominated in US dollars. So if all of those markets are rallying and rallying hard, how many dollars are required? Well, the answer is an awful lot more. Right? And so when we look at what happened this week now on the dollar index, what happened this week, we have seen. How about this, guys? Let's just get a handle on this, right? So this was the ECB talk from Lagarde. Dollar falls, but then completely reverses the next day to close on a short-term high. Look at that naked close. That's the best close we've had for ages and ages, going all the way back over to here. Almost a month. Okay, this to me suggests that we've had a false breakout to the downside. We're now on a new dollar leg higher. So what does that suggest? The dollar's on its way to 95 or 96, most likely. So where does this project to? Well, at the very least, we could take the high here at 94.5, the low here at 93 and a bit, and we could then take that distance and add it on again, which gets us to about the 95.5. That's the reason why I came up with those numbers. We just target shooted that away. Okay, guys, that's really it for me. So I don't believe that inflation is permanent. I believe it's transitory. For those of you interested, there was a very interesting Fed article around that just a few days ago. And at the same time, right, interest rates remain stubbornly low, which suggests to me that it is transitory, right? Because we always look at what the bond market's doing. The bond market knows best. It seems like, well, your old grandmother, right? She always has the right line at the right time. Well, the US bond market is the great grandmother of the financial markets. Then we've seen now a reaction in US dollars where we're beginning to see the stresses and strains of higher prices in the commodities coming through to the market. They're simply unbelievable. An extra $4 or $5 trillion have flown into these markets, but there isn't enough to go round. Isn't that amazing? There isn't enough to go round to pay for all of these commodities that are being bought at these very high price levels. So therefore, there is a shortage of dollars, and the dollar will continue to trade higher as those commodity prices trade higher too. Geoff, that is it for me, guys. I hope you guys all get that, and I hope that's cool and you understand it.
Cheers, mate. Look, as much as I hate to admit it, it does look as though the US dollar is going to be a little bit strong for a little bit longer. bugger.
Not against the Aussie though. I still like our Aussie trade, right?
Yep, still there. Look, Ainslie's not in today, so you've given a brief overview of oil. How about your stance on gold, if you don't mind?
Sure. Yeah. Why don't I have a quick look at that, guys? So, okay. So, I'll just park Geoff over there in the corner for a second, so you can all see my screen. Let's go have a look at what happened to gold. Well, look, I think the key thing about gold is let's start at the weekly chart, like I always like to, guys, just to get a feel for what's happening. So, big picture, what are we looking at with gold? Now, you guys who followed, anybody who listened into my show that Ainslie and I did, the Trader Cafe we did last week, where we looked at the fundamentals for gold and silver and also the technicals as well too, would know that we're both moderately bullish towards this currency. We still need to see that. The classic thing about being moderately bullish means that you're not wildly bullish. And why not wildly bullish? Because the market isn't wildly bullish. Okay, what we've got here, we still have this consolidation, but we don't think it's a bear market. We think it's a consolidation. We've got to try and get our way all the way through the month of November to about week 4 of November to then hit the seasonal bias where it starts to rally again, and we see that rally last through Q1. So key thing is here, can we hold the price levels we're at just for the next 3 or 4 weeks? So weekly chart, what are we looking like? Okay, we've got this big low down here at 1680. We then put a higher low in place here at 1720, and we have traded relatively well since then. Have we got above 1830? No, we haven't. A close on the weekly chart above 1830 would be a very powerful signal. Okay, looking at the dailies, what are we seeing on the dailies now? Okay, so here we go. Let's look at the dailies. So yet again, another struggly Friday that we saw, a struggly Friday. Hey guys, look, there's 2 bars down. I wonder what happened next. So a struggly Friday, but overall, the market is trying to grind its way higher. Where have we got key levels? Key resistance levels are here for me. We take out this price here, or we take out this price here. So 1810 to 1814, we get a close above those two, we are off and running. But as I said, it's going to be tricky because we've got to get through to the seasonal bullish time, which is in about 3 weeks, because everybody buys jewelry for Christmas. I don't think that's the real reason, but it sounds like a really good one, doesn't it, Geoff? So, because I know that you always buy your wife jewelry for Christmas, Geoff, and gold is your favorite color. And you're mute, so you can't talk back, which is even more awesome. So,
I'll be more mute when Christmas comes, because there'll be no silver, there'll be no gold, there'll be a nice wet kiss on the chops, and maybe breakfast in bed.
Well, as you know,
I'm a tight ass, you know.
Well, as you know, love trumps all, right? So
it does, mate.
Anyway, right, so here's the thing, guys. Let's just keep our bullish stance in this. Where are we wrong? Where are we wrong with our bullishness? So we start to head below 1750. Why do we have to head below here? Look at all this support level down here. Oh my God, crazy amount of support. All the way down here, right? We head below 1760, 1750. I think we've got a problem. I'd love to see us head just straight sideways from here on in. If we, again, another bullish point, medium term bullish, if we break even 1800 now, right? We break 1800, the bull trend remains intact. One of the things I recommend you do is look at some of the associated markets as well too. So if we looked at silver and see what's happening to silver, oh my God, how about a bull trend there, right? So about the same time as gold went down, and bounced. Look at what happened to silver. Silver had a false breakout to the downside. It came back inside this big trading range, hung around for about 5 or 6 days, and then took off. There we go. Look, breaching these 2 highs very easily, closed above it. Oh, look, 2 bars down. That's interesting. Oh, look, 2 bars down. That's interesting. Okay, then we had the big run up. For those of you who've just been watching the last show, you'll understand why I was saying that, right? And then now we've just gone into a small consolidation, but doesn't that chart look a lot more aggressive than the gold chart? Okay, so just bear this in mind, right? All the ancillary charts around it, nothing is bearish in there. The only thing that bothers me, okay, is this chart. This is the junior miners. I think what happened is everybody got so excited buying gold miners, right? So if you look at this, they went from 38 to 45, which is $7, $7.38. I don't know what that is, but that's roughly 20% to me. That's an insane amount, right? Okay, so all that's happened is we've come back a little bit, right, to try and stop those people out of their very long positions they've all acquired up here. The market went crazy for a few days, right? So just bear in mind that, within the gold, the actual gold miners themselves are trading a bit rough, and this is the seniors, so they've come back a bit too. Again, looking for some kind of bounce in here. We just need to make our way through to the end of November. If we take out this low here, 29, then all bets are off. But until that point in time, I think the gold miners are still looking good. And don't forget, they are way cheaper than they were before the last gold bull run. Geoff, how about that?
Mate, awesome. Thank you so much. There's a There's a cricket World Cup going on at the moment. How's your analysis on that?
The great news is that, as you know, I'm English, but unfortunately, that being English doesn't always qualify me to be an expert on cricket. The good news is, I think I gave up cricket when I was 14 years old, when I couldn't work out which end of the bat to hold.
Mate,
So-
welcome the Australians at the moment.
And the
Certainly
Black
not
Caps.
against your expats.
Well, yeah, the Black Caps don't seem to be that good either, I don't think. So I don't know. We're going to see. Pakistan look to be the team in form at the moment. We'll see how they go.
Yeah.
And
Incredible.
yeah, they look pretty hot at the moment. So good luck with those guys. They're due a really big win. So hopefully they'll come through. But who knows? Sport is sport. We got a long way to go. We're not even close to the playoffs yet. So anyway. Does that help? That's my cricket. That's my cricket analysis.
I think you're spot on the money with. I think the sentimental favourites have certainly got to be Pakistan, because couldn't they do with a lift?